morning as everyone kind of filters in here. Welcome to class number 8 of our 2025 virtual HOA and Condo Academy. In partnership with the cities of Avondale, Chandler, Glendale, Goodyear, Mesa, Peoria, Phoenix, Scottsdale, Surprise, and Tempe. So welcome everyone. My name is Haidyn Dilorenzo. I am an associate attorney here at the Mulcahy Law Firm. I've been with the firm for about 4 years now, and in that time, I've enjoyed representing many Arizona HOAs and condominium associations. So we're very excited to jump right in today, but before we do get started, I'm going to go ahead and turn this over to my colleague and co-host of today's Zoom, Madeline Gegg, for a brief introduction.
Thanks, Haidyn, for getting us started this morning. Like Haidyn said, my name is Madeline Gegg. I'm also an associate attorney at Mulcahy Law Firm here in Phoenix, Arizona. I've been an attorney here at Mulcahy Law Firm for a little over a year, and during my tenure so far, I've really enjoyed serving planned communities and condominiums around the valley. I'm excited to be here this morning to discuss association finances as we kick off our annual budgeting season. In today's class, we are going to discuss a financial overview covering important topics such as creating the 2026 budget, interpreting financial statements, the treasurer's and board members' financial responsibilities, and understanding reserve studies and reserve accounts. As always, we'll address questions at the end of our class, and we will conclude the main presentation right around 12, and then we'll move into questions at that time. For today's class, all questions were to be pre-submitted by 4 p.m. yesterday via a form that was sent out in our Mulcahy memo. And all questions received today will be rolled over to our live virtual First Friday event happening on September 5th at 9 a.m. So if your question wasn't able to get answered today, be sure to tune in for our next session. I believe our team just launched our first poll. This will be, before we're diving into the seminar, we like to start by getting a feel of who's in attendance today so that we can tailor the information to best serve all of you. So we definitely ask that you answer those polls as they come in, and we'll be reading out the results shortly as well. And then our second poll question will be to please let us know your current role. If you're a board of director member, a community manager, a homeowner, or maybe somebody else who's just interested in one of those roles. So we'll wait on those results, and before they come in, oh, here we go. So it looks like we've got a few folks from Avondale, several from Chandler, a few from Glendale. We have some folks from Goodyear, a good chunk of people here from Mesa. Hi, Mesa. Some people from Peoria, a big chunk of people from Phoenix and Scottsdale, some folks from Surprise and Tempe. And then it looks like the majority of people in attendance here are on the board of directors, so we're always happy to have you. Some community managers, some interested homeowners. We always love to see homeowners participating as well. And then a few people that fit into that other category. So thank you all for responding to that, and thanks for being here. We're going to get started today with an update on the pending legislation. The Arizona legislature began the 2025 session on January 13th, 2025, and adjourned on June 27th, 2025. This adjournment was following a lengthy budget battle that nearly resulted in an unprecedented state government shutdown. Luckily, Governor Hobbs signed the bipartisan negotiated budget bill on June 27th. During the legislative session, Governor Hobbs also signed 4 bills into law that directly impact community associations. These 4 new laws will become effective on Friday, September 26, 2025. Additionally, we're going to highlight 3 other bills that were signed into law that may be of interest to community associations. These of interest bills will also become effective on September 26th unless otherwise indicated. So starting off, we'll talk about those 4 bills that are directly impacting community associations. First is SB 1039. This is regarding homeowners association meetings and recordings. So this bill will require that if a board records a meeting that is open to members, the board shall keep a copy of the recording for at least 6 months and make the unedited recording available to any members on request. So the next one is SB 1378, political signs. This bill changes the definition of political signs to include a sign or flag. I'm glad that the legislator cleared that one up. We got a lot of questions about that in 2024. In moving on, we have SB 1494, the common expense lien foreclosure amount statute. So this is amending ARS 33-1807. So that's specifically applying to planned communities. And it is upping the threshold for what can constitute a foreclosure lawsuit. So previously, it was if an owner was delinquent for 1 year or in the amount of $1,200, then the association could move forward with foreclosing a lien. But now it will be that the owner has to be delinquent for at least 18 months or delinquent in the amount of at least $10,000. This amendment also changes assessments to any assessment or portion of assessment, and there's a few other technical corrections in there. Lastly, we have HB 2322. This is regarding condominiums, specifically condominiums with commercial and residential structures. This bill addresses assessments on commercial versus residential structures within a single condominium. And this bill will also include some definitions that help to specify what constitutes a commercial structure, what constitutes a common expense, and what constitutes a residential structure. This bill only applies to condominiums. Next, we've got those three that I mentioned at the top of this section that are not specifically applied to planned communities and condominiums, but may have some relevance to our community associations here in Arizona. First, we have SB 1022. This is regarding small claims court, and it changes the jurisdictional limit. So this bill will amend ARS Section 22-503 to raise the small claims court jurisdiction limit to 5,000. Before that, it was 3,500. Next, we have SB 1070. This is a tax deed land sales procedure bill. So this will allow County Board of Supervisors to sell real property in the county that is held by the state by a tax deed to the owner of contiguous real property that is used for commercial, agricultural, or residential purposes, subject to certain specific requirements. More specifically, and how this may apply to planned communities and community associations, is that this bill also authorizes a County Board of Supervisors to sell similarly situated real property to a homeowners association if the property is part of a common area maintained by the homeowners association. Then our last legislative update today is going to be HB 2928. So this is regarding accessory dwelling units. This amendment will address regulation of accessory dwelling units, or ADUs, by municipalities and counties. So this applies the, quote, more than 75,000 persons population criteria to the entire state on municipal regulation, rather than only those places where single family dwellings are allowed. And this bill will also add an exemption for lots that have a noise level of greater than 65 decibels. This allows municipalities and counties to require the owner of an ADU to live on the property if there's a certificate of occupancy or similar approval that was issued on or after September 14, 2024. This bill will also exempt certain historical properties from administrative approval without a public hearing. That part isn't effective until December 31st, 2025. This bill also adds a provision for county regulations of ADUs similar to municipal regulations that went into effect last year in ARS Section 9-46118. And if the county fails to adopt any regulations by January 1st, 2026, ADUs will automatically be allowed on all residentially zoned lots within that county without limitation. This bill also states that county ADU regulation provisions do not prohibit restrictive covenants between private properties regarding ADUs. So that's where our community property and community associations can still have ADU regulations and rules. And finally, this bill will allow counties to require adequately sized septic prior to the construction of an ADU under certain circumstances. So that one was a lot, but a little bit of a change in the regulatory space regarding ADUs. That concludes our legislative summary for today. And so we'll be looking for those results, or for those laws to come into effect here in the next month in September. On to the meat and potatoes, the main presentation today. So we'll start by answering kind of a simple question to get into the budgeting and finance portion of the seminar today. And that question will be, what is a budget? A community association budget is an itemized summary based on the anticipated income and expenses for each fiscal year. Most community association documents require that the board of directors adopt a budget for each fiscal year. In most associations, fiscal year is the calendar year, so the board will start working on the budget in the late summer or early fall. This is why we call this the budgeting season. Each association should check its governing documents to determine the requirements for preparing the annual budget and whether the members are required to participate in the budgeting procedure or whether the board is solely responsible for preparing and approving the budget. The budget will consist of various line items reflecting the anticipated income that the association anticipates receiving. So that'll be income from assessments, special assessments, late charges, fines, penalties, interest, income, reimbursements for attorney's fees and costs incurred by the association in enforcing the governing documents. In addition to the line items reflecting various sources of income, the budget will include the anticipated expenses for the next fiscal year as well. The association documents usually set out the association's responsibilities, and the cost of all those expenses should be reflected in the budget. This would include any kind of recurring repair costs, utilities, landscaping, pool maintenance, maintenance of private streets or parking areas, gate maintenance is a big one. If the community has controlled access, any management fees, legal and accounting expenses, all the expenses of any vendors that the association works with, etc. So I think that we did just have our next poll question pop up, which was, what has been your board's primary challenge in creating the budget? So thanks for putting in your answers with that. Next, we've got, who is preparing the budget? Oh, here's our results there. So the question was, what has been the board's primary challenge in creating the annual budget? It looks like the majority say that the planning for long-term repairs and replacements is the biggest challenge. The next biggest challenge, almost equal, is keeping up with rising costs. That's something that's coming out quite a bit, especially rising costs of insurance. Next, the next biggest choice was owner member resistance to assessment increases, and then understanding legal requirements. Now, with owner and member resistance to assessment increases, this one's tough, especially if your governing documents require the owners to approve or ratify the next year's budget. But we can talk a little bit about ways that we can increase owner approval a little bit later on in the presentation. But it's one of those things that nobody wants their assessments to go up, but if you really understand the process and why assessments might be raised, then people might have a better understanding. Thanks for that. So preparing the annual budget. If the association is managed by a management company, that management company typically prepares the budget for the board approval, since that management company typically pays the bills for the association and has all the backup information that's required for preparing the budget. However, the treasurer or maybe an association's finance committee or special budget committee can also assist the board with that process. A lot of times the treasurer will kind of work hand in hand with the management company on that first draft. In a self-managed association, the treasurer and any kind of budgeting finance committee typically completes the budgeting process and prepares that first draft entirely on their own. Whether it's the manager or an officer of the association or a committee that's responsible for developing this first draft of the budget, it takes time and planning and a lot of careful attention to complete the process. The budgeting process begins by reviewing the association's documents to determine whether there are any specific requirements for preparing that budget. A good rule of thumb is to have the budget completed and ready for approval at least 45 days prior to the date that may be required by the association's documents. Or if there isn't a date in your documents, then 45 days before the beginning of the fiscal year. Typically, if the association's fiscal year is the calendar year, we really recommend that the budget should be ready for approval at the November regular board meeting. Now I'll cover steps for creating a budget and some questions to ask along the way. First, we recommend that you review last year's budget and all the financial records to compare the differences between what was budgeted and what was actually spent. We hope that you are able to review each line item in the budget and see, is there a difference between what was budgeted and what was expended? What was the reason for any differences? Was there any kind of specific circumstances that raised a particular bill? For example, if there was a lawsuit that was out of the ordinary, maybe your legal bills were a little bit higher or something like that. Next, we recommend that you evaluate the needs of the community for the upcoming year. Does the annual assessment need to be raised because of an increase in delinquencies or maybe increase of costs of operating the association? Is it anticipated that the board will need to make new expenditures that benefit the community? Or do you estimate any expenses to exceed the estimated revenue? This will be important. So say, for example, your pool cleaning contract is going to be up in the next coming year. Maybe you can anticipate that that price will go up. And this is somewhere where the needs of the community might be different from the year before. Which brings us to our next step, which is assess the needs of the community for the future. What long-term or capital projects need to be addressed in the reserve budget? When was the last reserve study conducted? Considering increases in the operating expenses, should a new reserve study be conducted? Does a larger percentage of the annual assessment need to be directed to the reserve budget? Ask questions of the association's vendors. So like the example that I just gave with the pool contractor, maybe that contract coming up, are there any potential cost increases or added services that a vendor might deem necessary for the association? Are proposed cost increases necessary? So maybe if you are in communication with your vendors and you know that one of them is planning to raise prices a certain amount, maybe you can see if those services can be adjusted and you can stay with that main vendor. Or maybe it's something that the board will want to consider bidding out. Which brings us to step 5, of course, is review and analyzing the association's contracts. Are there changes in services that may require an increase or a decrease of the contract amount? Is the association required to obtain 3 bids from outside vendors to determine if the value that they're getting in the current contract is what they should be spending? Should existing contracts be put out to bid with other vendors? And these are questions you can ask while you're reviewing all the association's contracts. Next step is to receive and analyze information obtained from the vendors and determine the amount to be included in the budget. So once you've gotten your bids, once you've received all the contracts, then you can kind of decide what exactly that line item will look like. Next, you'll want to plan for the unexpected and miscellaneous expenses. While the board should not necessarily be expecting surprises, it is prudent to always include a line item for contingencies, which would include any unanticipated expenses. Unfortunately, these happen all the time, so it's always good to have a little extra funds in the budget in case something comes up. Once all of that's said and done, we recommend that you budget the amount to be placed in each line item after concluding the research. And finally, you'll be analyzing the estimated expenses. If expenses exceed the initial estimated revenue, then the board will need to decide whether to reduce expenses, increase assessments, or impose a special assessment. So our next poll was, is your association considering an increase in assessments? So assessments being monthly or quarterly dues as part of the 2026 budget. So I think that we'll be getting the results of those soon. Thanks to everyone who participates in these polls. They really help us. So looking at the numbers now, it looks like overwhelmingly an increase of assessments is planned. 50% said yes, 22% said maybe it's under consideration. So that's almost 3/4 of people either certainly raising assessments or considering raising assessments. We have some associations who are saying, no, it's going to stay the same, which is sometimes a good thing. And then some who are not really sure yet. So we'll see how that shakes out in the next few months. Next, we have presenting the budget and adopting the budget, that process. So the budget should be reviewed and approved by the board of directors. If required in the association documents, the homeowners would then approve the budget once adopted by the board. When presenting the budget to the membership, we recommend that boards also do the following. Always present backup information on how the line items were determined and how estimates were obtained. Provide accurate and simple information that is easily understood. Discuss the most important line items, for example, those that the members might be the most interested in. Address trends that will help to show the future of the association's expenditures, and be open and ready to answer all questions. The budgeting process is maybe the single most important thing to an association and probably the most hot button topic when you're having your meetings. So it's really, really important to be as transparent as possible, to answer as many questions as possible, and to just give all the information that you possibly can to the membership. This is one way that you can help secure support for the proposed budget and make sure that you don't get a lot of opposition, especially if a vote or approval from the membership is required to move forward. By Arizona law, the process for adopting the budget can actually differ between planned communities and condominiums. For a planned community budget, the budget must be approved and adopted by the board, but there's no requirement in the Planned Community Act that mandates that the board be approved by the membership as well. While the association documents could require membership approval, it is our firm's experience that this is kind of unusual for planned communities. One thing that we do see a little bit more often with planned communities is that any kind of special assessment or any assessment increase that is over a certain percentage, maybe 15%, 20%, that would be something that requires membership approval. The condominium budget, on the other hand, has a little bit of a different process. The Arizona Condominium Act, specifically Arizona Revised Statute Section 33-1243, requires that the board of directors provide, usually by mail, a summary of the proposed condominium budget to all unit owners within 30 days after adoption. So if the board is adopting their next budget at that November board meeting, within 30 days of that meeting is when this summary would need to be mailed out. According to this statute, the unit owners are required to ratify the budget or any amendments to the budget unless the board of directors is expressly authorized in the declaration to adopt and amend budgets. If ratification is required, the board of directors is required to notify a meeting of the unit owners within 14 to 30 days after mailing the summary to ratify the budget. The budget is ratified whether or not there's a quorum, unless a majority or any larger vote of the unit owners, as specified in the declaration, rejects the budget during that meeting. If the proposed budget is rejected, the budget that was previously ratified by the unit owners, usually the previous year's budget, will continue to be in effect until the owners subsequently ratify the budget proposed by the board of directors. Note that there's no requirement of membership approval if the declaration expressly states that the unit owner's approval is not necessary. So for condominiums, it's a little bit of a longer process unless the board has that express authorization to adopt and amend a budget. So you're kind of looking for like a more up to 2-month long process. So from when the board adopts the budget, then the summary goes out within 30 days. And then within 2 weeks to 30 days after that is when the meeting has to be held. And that's when the membership will vote as to whether to ratify that budget. Okay, moving on from the budgeting process, we've got a little bit of details on kind of how the budgeting goes versus in operational budgets and reserve budgets. So the association budget should consist of an operating and a reserve budget. The operating budget consists of the usual and customary expenses incurred by the association on a regular basis, such as the management fees, landscape and pool maintenance, insurance, legal fees, water, any kind of social programs, etc. The reserve budget, on the other hand, consists of those funds necessary for large capital expenditures, such as a big painting project, paving private streets, roofs if roof maintenance is required by the declaration, any kind of common area improvements, etc. Both the operating and reserve budgets need to be addressed annually and budgeted appropriately. Now about the reserve study and funding. It is always best practice for a board to plan for and have a reserve study completed and updated every 3 to 5 years, depending upon the extent of capital items in the planned community for which the association is responsible. Now, we always like to talk about the reserve study and funding, but one thing that's kind of important when we're talking about that is to acknowledge that getting a reserve study done can be a pretty expensive task. So the cost of your reserve study should actually be something that's considered in that operating budget. Another thing that we like to point out is there's a big difference cost-wise in having an entire reserve study done from a new company, for example, or the first one ever, versus updating the reserve study. So if you have a reserve study from, say, 5 years ago, and you're comfortable with that company, for them to come in and update the reserve study may be significantly more affordable than having a new study done entirely. So it's important to review your governing documents, see what they say about the reserve study requirements, but then also make sure that you're working with vendors. And if you find one you like, it's always good to go back to them, and maybe that can help you save some money in the long run. The reserve account should be adequately funded in accordance with that reserve study. So a reserve fund has a lot of purposes, but these purposes include that they provide for the planned replacement of major community assets. That could be redoing the pool, replacing the gate, big painting projects, like I said, a lot of things that would be too expensive to cover in the normal operating budget. The reserve funds also distribute the monetary contributions of old and new owners. They reduce or eliminate the need for special assessments, and they definitely enhance the resale value of homes because reserve funding policies is something that's always disclosed to new purchasers. The reserve study also identifies common area components like roofs, painting, siding, paving, gates, like I mentioned, for which the association has a maintenance responsibility. So these companies will go through your governing documents and make sure that anything that needs to be repaired when replaced by the association is included in that reserve study. And then the study will assign a useful life and a replacement or repair cost to each component, or an estimated range sometimes, and a long-range funding plan so that the future maintenance occurs without the need for a special assessment. It is probably the single most important piece of the budget because it provides a long-term plan for the board to follow, which is really great because specific board members can change with each election, but this makes sure that each new board even can kind of stay on the same path. It also is really helpful to relieve the board from pressure to not raise fees or not issue special assessments because the reserve plan will dictate a prudent course of action that considers all owners' interests and doesn't really focus on any particular board member or other individual homeowners' interests. More importantly, associations with a reserve plan are more inclined to maintain the property in accordance with that plan, which has a really positive effect on the resale values. Now, our team is going to share, if they haven't already, the Budgeting for Community Associations cheat sheet that we have. And while they do that, I will turn things back over to my colleague, Haidyn Dilorenzo, to finish this portion of today's seminar. Thanks.
Awesome. Okay. Thanks, Madeline. As a point of transition here, let's go ahead and share the results of that poll question that was launched a few minutes ago. So it looks like the question was, how confident are you in interpreting your association's financial statements? So this is some good news. It looks like about 50% of you said you're very confident. Glad to hear that. About 31% said somewhat confident, 13% said not very confident, and 6% said not at all confident. So thank you guys for sharing that with us, and hopefully we can give you some good information here to help out with that if you're on the less confident side. So just to begin my portion of this presentation here, we'll start off with some fiduciary duties and procedures. So what is a fiduciary? A fiduciary is someone that holds something in trust for another. So the duty of a fiduciary is going to be a duty of care in addition to a duty of loyalty. So let's talk a little bit about the duty of care that you have as a board member. Directors must make an honest effort to make an informed decision concerning each issue that comes before the board of directors, understanding the issues and options that are brought before the board. So if necessary, the board should be requesting the advice of competent experts or practitioners and listen to those opinions. Now, on the topic of the duty of loyalty, directors must refrain from taking actions that will benefit them or parties related to them to the detriment of the association. And then finally, the duty of confidentiality. In exercising this duty, directors acknowledge that information that may come into their possession as a board member has proprietary, confidential, or privileged status, whether that information is communicated to them in written or verbal form. So a director agrees to maintain the confidentiality of all information provided to them, and agrees not to disclose proprietary, confidential, or privileged information to anyone outside the board without prior written authority or approval from the entire board of directors. So let's talk a little bit about some of the procedures for the board. So as you know, as a business, an association must follow some formalities and procedures in connection with its operation. So reporting, meetings, notices, and voting as outlined in the governing documents must be followed, because failure to do so may affect the legal status of the association and can create a liability, allowing exposure to a potential lawsuit. So we will go ahead and share a cheat sheet with you. This is going to be a little bit about responsibilities of the president and vice president, but this will also have a little bit of information, I believe, with regard to the treasurer. Now, the treasurer is going to be kind of a big key player in the association when it comes to exercising the fiduciary duties of the association. So just a little bit of information on the role of the treasurer. The community association treasurer is typically responsible for assuring that a draft budget is prepared and reviewed. With a managed association, the duty of drafting the budget will sometimes be delegated by the board to the association's manager, although it remains the board's duty to approve the budget once prepared by the manager. Once management has prepared the draft of the budget, the treasurer is usually the party that will review the budget and discuss that with the board of directors. So we've also got, I believe a second cheat sheet coming in for you, and that's going to be board member roles and responsibilities. So a little bit more on the role of the treasurer. The treasurer is responsible for reviewing and understanding the association's financial records every month and being able to give a complete review of the association's financial status to the board at the board meeting. Additionally, the treasurer has the responsibility of overseeing the preparation of the annual operating budget, and a few other key responsibilities include monitoring the progress of the annual audit or financial review under Arizona law, and ensuring the timely filing of appropriate tax returns and monitoring insurance for the board, as well as for the association. So a reminder, if a management company does maintain the association accounts, it remains the treasurer's responsibility to closely review the accounts. The treasurer should also put some safeguards in place and some internal controls to be sure to protect the association's assets and prevent the misuse of association funds. So unfortunately, we do see this from time to time, so we do recommend putting some of those safeguards in place just to make sure that you're adequately protecting the association. So a treasurer who's aware of all aspects of the accounting for the association is a good way to do this. The treasurer may also oversee a reserve program and work with the board to assure that a proper reserve study is completed and that funding is adequate to support that study. Now, in addition to the treasurer's role in this, the president will also oversee the association's fiscal well-being, including directing the budget process, collecting assessments, and ensuring that reserves are adequately funded, and that insurance coverage is sufficient to protect the board and the association. So they kind of work in tandem with the treasurer in that regard. Okay, so let's talk a little bit about reserve studies. I believe we do have a poll coming in for you if it hasn't dropped already. It's going to be a little question about reserve studies for you. Looks like it just popped up. So as we get that question answered and as those results are loading, I will give you guys a little bit of info on reserve funds for community associations. I know Madeline did cover this a little bit in her part of the presentation. I'll just give a little bit of an expansion on this for a little bit more detail. So as an initial tip, Arizona law does not require a developer or an association to create and fund reserves for a community association. But it is important to note that your community documents for your association, like your CC&Rs and bylaws, may require this. So it's important to check there as well. Adequate reserve funding is always in the best financial interest of the association. So we do recommend, performing one of these studies. But reserve funding allows an association to provide for the repair, maintenance, and replacement of the association's assets as the community ages. So let's talk a little bit about what a reserve study is. So the reserve study is a budgeting guide that will provide a comprehensive plan that shows an association how much is reasonable to place in reserve for a specific replacement or maintenance project. So when properly executed, the reserve study can give a clear picture of the maintenance, repair, or replacement requirements of association assets for the duration and life of the association. So a reserve study is going to start with an accurate inventory of the association's community assets to determine the useful life of those assets and provide a review of the association's documents to determine the responsibilities of the association regarding property and assets. So there's a couple things that a reserve study should provide. So the first is a detailed inventory of association assets that are labeled as assets for the reserve account. It should also provide the location of the assets, the current age and remaining life of each asset, creating a timeline for scheduled repair, maintenance, or replacement. Additionally, the cost to replace each asset when necessary, the costs of repair or maintenance, and then a calculation of the monthly contribution required to have proper funding for the repair, maintenance, or replacement as needed. So why should an association establish a reserve fund? So a couple of reasons. Number one, educated homebuyers may not invest in a community that's not maintained, a community that has debt, or doesn't have an adequate reserve fund. So additionally, lenders may not approve mortgage applications in communities with no reserves or low reserves. While Arizona doesn't require reserves or a reserve study, planned communities and condominiums in Arizona with 50 or more lots or units are required to disclose to purchasers the amount of money held in reserves and to provide a copy of the most recent reserve study done, if any. In a disclosure statement pursuant to ARS Section 33-1806 for planned communities and ARS Section 33-1260 for condominiums. So that's just an important thing to be aware of regarding your association's reserves. So there's a couple more just important reasons that we think it's important to be having and maintaining a reserve fund. Number one, reserve funding will ensure that your association is meeting their legal, fiduciary, and professional requirements. Number two, a reserve fund provides for the planned replacement of major items, so it's just a good planning tool. Number three, a reserve fund distributes the contributions of old and new owners in a more equitable and fair way. And then number four, a reserve fund minimizes or negates the need for special assessments. And then lastly, a reserve fund enhances resale values because associations must disclose information about their reserve funding policies. So all around, we would just highly recommend it. We think it's a very good idea. Now, how does the association determine an adequate reserve fund? So the reserve study inventory should determine assets that will be included in a reserve budget and also label those items that will be operational expenses. So let's talk a little bit about operational expenses versus reserve expenses. So when it comes to operational expenses, these are going to be typically characterized as reasonably predictable in terms of frequency and cost. So these are relatively minor expenses that wouldn't adversely affect the operational budget from one year to the next. So some examples of operating expenses are going to be things like utilities, administrative expenses, services like landscaping, pool maintenance, management and repair expenses, such as small equipment repair. Now, by contrast, reserve expenses are going to be capital expenses and major expenses other than annual expenses that are reasonably predictable as to frequency and cost. So they must be budgeted in advance to provide the necessary funding, or the owners could face a special assessment, which we try to avoid when possible. So examples of reserve expenses could be things like painting the buildings, painting fences, asphalt repairs, pool and spa resurfacing and equipment, clubhouse remodeling, roof replacement, things of that nature. So upon completion of a reserve study, it will be necessary for the association to review the study as it applies to the budget and future funding to determine the necessary assessments required to meet the reserve's timeline. Typically, with each member's monthly, quarterly, or yearly assessments, a percentage of that assessment will be placed in the reserve account. And by creating a reserve fund that allows members to contribute equally to each assessment, special assessments can be lessened or eliminated. So a special assessment, the reason that we try to reduce, the occasion of needing to implement a special assessment is because a special assessment places the burden of replacement of an item on those members currently living in the association. When residents who have lived in the association but maybe moved received the benefit of that asset without paying for it. So with that in mind, it's just best to avoid special assessments if possible as a rule of general fairness to the community. But we understand that sometimes a special assessment does become necessary. And in those cases, we think that it's a good idea to move forward with those. So when a reserve study is completed and implemented, the association can plan for efficient payment of major expenses, thereby offering residents a fair distribution of payment responsibility over the life of the community. All right. And it does look like our poll results have come in from that last poll that popped up. So I'll go ahead and just read those out for you right now. The question was, when was the last time your community association conducted a reserve study? So it looks like about 54% of you said that you had a reserve study done within the last 3 years, which is great. About 15% said 3 to 5 years ago. About 9% said over 5 years ago. 16% were unsure. And then 7% said that their association has never done one. Now, as we kind of discussed before, that's definitely not necessarily a problem if your association hasn't done one or if it's been a while. You just want to be sure that you're checking your association's documents to make sure that you are doing those at a frequency that's required under your association's documents. All right, so thank you all for participating in that poll. I'll go ahead and talk to you a little bit about the cost of a reserve study. So experts generally recommend that reserve studies be reviewed or updated every 5 years, which allows for the opportunity to adjust the funding requirements as needed. Because of the technical details involved in the development of a reserve study, the association should consider hiring a qualified reserve study professional when doing these reserve studies. So a professional reserve study will typically range between $1,500 and $5,000, depending on the size and amenities of your association. Now, if that's a little steep for your association or your association can't afford to hire a professional, there are some really good do-it-yourself software programs and worksheets that are available, and these typically fall in the range of about $250 to $1,000, so maybe a little bit more affordable for your association, depending on its needs. Okay, now that we've talked about what should be included in your association's reserve study, let's talk a little bit about what should not be included. So budgeting for assets that would have an estimated useful life equal to or greater than the community itself is typically excluded from reserve funding. So some examples of this would be the complete replacement of elevators or, say, electrical wiring within your association. Insignificant expenses that are covered by a general maintenance fund are also usually excluded. Things such as natural disasters or accidents, these will typically be insured for and aren't usually included in the reserve funding for that reason. Okay, we will go ahead and share a cheat sheet with you, which is reserve funds for community associations, if you want a little bit more detail on that. Now, one thing we do hear from clients sometimes is we run into a problem of inadequate income. So if your community is looking at a financial crisis, or if you're dealing with an inability to pay bills, pass a special assessment or raising assessments, there are a couple of things that our firm would recommend to you. The first thing that we'd recommend would be just to conduct a 360-degree overview. So just conducting a thorough assessment of the association's financial situation, which will include things like outstanding debts and obligations. And then reviewing the current budget to identify areas where expenses could potentially be reduced or reallocated. Secondly, we would recommend prioritizing essential expenses, so for example, utilities or insurance, to ensure that all critical services are maintained while you're kind of figuring out the rest of the funding. Thirdly, this is one of those situations potentially where a special assessment might be up for consideration. So we would recommend evaluating the feasibility of a special assessment and communicating the necessity of a special assessment to the homeowners. Ultimately, we find that just being open and honest with the owners and letting them know the need and the reason for the special assessment is a good way to get them on board with proceeding, even though it can sometimes feel not as ideal to have a special assessment imposed. And then lastly, as I kind of just mentioned, we do recommend communication and transparency in these kinds of situations. If the association is facing a little bit of a tough financial situation, we recommend informing the owners of that and the board's plans for recovery and any proposed changes that you might have. So that is going to go ahead and conclude my portion of the presentation today. I will go ahead and turn it back over to Madeline, and we'll get started, I believe, on our Q&A, or maybe that's in a little bit. I'll turn it over to Madeline for now.
Thanks, Haidyn. And one final thing to do if you're facing an association with inadequate income is keep attending our free seminars, right? So I am going to come back in with a little bit more details. Since this presentation is focused on association finances, we'll briefly address a sensitive but also really important topic, which is theft of association funds. This is something that we can and usually do a whole presentation on, but we always like to bring it up when we're talking about communication or community finances, because while you're looking at budgets and looking at line items closely, it's important to keep in the back of your mind, especially if you're seeing some unexpected numbers or some weird inconsistencies. Unfortunately, this is an issue that has become more common in community associations. In recent years, Arizona's media has reported cases such as misappropriation of funds by a management company, sudden closure of small management companies after individuals absconded with the funds from several associations, and sometimes even embezzling over $1 million from an association. If you haven't heard about this yourself, that's probably a good thing. It means it's not happening in your community, but we definitely see it weekly from our Google alerts in community associations across the country. So there's always the question, what can the association do? It's important to understand and identify the risk that associations face and implement steps and actions that board members can do to help prevent the association from falling victim to this kind of crime. Starting off, it's important to identify perceived opportunities. There is a well-known criminologist and expert on the sociology of crime, Donald R. Cressy, and he created the theory of the fraud triangle to kind of help explain the components that need to be present to allow some kind of white-collar criminal to commit occupational fraud. In this model, there's 3 sides of the triangle, which are rationalization, social pressure, and perceived opportunities. 2 legs of the triangle, which are rationalization and social pressure, those are difficult for an association to manage. However, perceived opportunities can be managed quite effectively by the association. Practicing good risk management and being aware can mean the difference between operating without any theft or fraud and being another victim. So a couple things on misappropriation of funds, like what does it look like? It can look like a variety of different actions, but some examples are the outright taking of cash, faked expenses, non-existent employees or former employees that are still on the payroll, transferring association funds to another community, the management company or the manager, use of association funds as collateral on personal loans, showing investments on the financial statements as certificates of deposit when they're actually non-existent. A manager may be paying personal bills with the association's funds. A few warning signs of potential fraud include the following. missing bank statements and reconciliations, general ledgers that don't add up, that don't balance, missing or altered documents, photocopies rather than originals, unexplained cash shortages, unauthorized credits to receivable accounts, increased past due accounts, duplicate payments to vendors, unexplained overdrafts and other bank charges, any unauthorized purchase, transaction, and payments for unspecified services. Accounting checks and balances are vital steps towards protecting the association's assets, but vigilance and awareness are also needed. The board of directors should periodically set aside time to do a full discussion of all financial matters facing the association. And above all, they must maintain a level of skepticism. Ultimately, the buck stops with the treasurer, and the treasurer must be especially vigilant with oversight of association funds. A good time for the board to look at everything is when preparing those monthly financial statements.
Sure.
Some other tools that the board can implement to prevent falling victim to theft and fraud. The board of directors should select a team of advisors and/or a management company to best serve the association. And depending on the size of the association, advisors can include some or all of the following: attorney or legal counsel, an insurance agent, a CPA, an investment consultant, or even a reserve specialist. The board should always do its due diligence and research any advisors before they hire them. Select advisors who are knowledgeable, who show that they can be available to the association, who are experienced, and who are dedicated to community associations. Additionally, there must be excellent communication between the association's treasurer and those trusted advisors, and also among the board of directors themselves. A major decision of the board of directors is selecting a management company to perform financial services. I feel like the vast majority of community associations in Arizona do employ a management company, even if it is just on a really basic level where they don't do much of the day-to-day operations or CC&R enforcement or things like that. If they're ever employed in just a kind of one area of association management, it's usually financials. So working together, the board and the advisors can make a good selection of a management company by considering the company's reputation for integrity, the experience of the management company and the managers that work there, the qualifications and processes followed by their financial departments. If your community ever is looking for recommendations on a management company, always feel free to reach out to our firm. We work with some really amazing management companies around the valley that we really trust. When hiring a management company, you should always ask questions of other community associations who have had successful working relationships with that company. It's also perfectly acceptable and sometimes necessary to research the management company and their specific employees. One or more key board members, including the treasurer, should usually take the time to visit the management company site, tour their office, meet with key personnel, and ask questions if they conduct criminal background checks regarding employees, especially those who handle association funds. Ask to maybe see the report. You can always inform the management company of any concerns the association has and see if they have any due diligence processes to protect the association funds from theft and embezzlement, and ask what prevention measures the management company has in place. And also, you can always ask what insurance they carry. It's important to also inquire about the management company's policies and methods regarding the working relationship with the board of directors. The management company and the manager should know the board and always have a good working relationship with them. A report of the visiting board members' findings should be presented to the rest of the board after they conduct that on-site visit. And then that can be something that's considered in moving forward with the process of selecting a management company. This is something we also have a cheat sheet on. It's our how to select a management company cheat sheet, and that gives a little bit more information on that process. But I just wanted to include some of that information as it pertains specifically to the risk of financial crime. Another key step in prevention is to review the association's insurance coverage. A board of directors' primary responsibility is to preserve and maintain the association's assets. Associations should carry employee dishonesty or crime insurance coverage, or sometimes known as a fidelity bond, in addition to any coverage that the managing agent might carry. This policy should cover anyone who has access to the association's funds. This is something we also always want to bring up around annual meeting time, because if there's a change on the board of directors, it's really important to make sure that the new directors are covered by those policies and that those policies are updated with the new names. You should also review the coverage offered by the insurance company and meet with your agent to make sure that it meets the needs of the association and covers some of these aspects of employee dishonesty, forgery or alteration of records, protection while on association premises, protection while in transit regarding association business, money orders and counterfeit currency, and computer fraud. Some more tips are that we recommend are to always be aware, be vigilant, and to always take control of any situation that doesn't seem like it's all quite panning out. Always keep association records up to date. Don't ever fall behind on financial statements and budgets. So earlier I mentioned maybe doing monthly financial statements. This is a really good idea, especially if you're monitoring for fraud and theft. Assign control of all reserve funds to the entire board, not just one person. Monthly financial reports should be prepared and made available for the board to review. And these should include a balance sheet, a statement of revenues and expenses, a comparison of actual revenues and expenditures that were budgeted on the original annual budget. Another step you can take is to require 2 signatures, including at least one board member, on all checks or transfers greater than a pre-designated amount. Some associations will do maybe $10,000 as their pre-designated amount. So that would require maybe the manager signs it and then maybe the treasurer or the president as well. Before signing a check, authorized check signers must review invoices and supporting documentation. So if you get an invoice from a vendor and you need to pay them, I would also recommend making sure that you double check those invoices for the work that was done, make sure the work was actually done before paying them, and making sure that the work was done to the association's standards. You should also review bank statements and reconciliations every single month. Another tip is to only keep a small amount of petty cash on hand and in a secure place, and always have a procedure for keeping track of petty cash. You should also be regularly reviewing delinquent receivable balances, including delinquent owner accounts. Purchasing adequate fidelity insurance that I spoke about. In addition, arranging for directors and officers coverage, so D&O insurance in the event a board manager or a board member is accused of financial mismanagement. You should also consider hiring a CPA to conduct an independent annual review or audit. And if your board discovers that funds are missing from your association, remove the suspected fraud perpetrator from a position of control and put a stop to all bank account activity. Always notify your insurance carrier and check with your association attorney for advice on how to proceed. This is something that people should really be acting quickly on. So if there's ever a red flag that goes up, you can always resume activity as normal, but you can't ever go back in time and wish that you acted sooner. So this concludes the substantive portion of our seminar today.
It does look like we had 232 viewers at peak today during the presentation, which is a new record for us for 2025. So thank you all for being here with us today. We really appreciate it, and we love hanging out with you and giving you a little bit of helpful information, hopefully. As a few closing remarks, I will go ahead and remind you about our firm's First Friday events. Our next First Friday event will take place on September 5th at 9 a.m., where Beth Mulcahy will be rapid fire answering questions live via Zoom and on Mulcahy Law Firm's Facebook page. Next, we've got some information regarding September class number 9. This will be taking place Tuesday, September 16th at 11 a.m. from 11 to 12. And this will also take place on Zoom and Facebook Live. Now, this is the 2025 legislative update, insurance challenges, and community safety. So this session will provide an easy-to-understand overview of the new legislation affecting HOA and condo boards. And we will address the current insurance challenges facing HOAs and condos and offer some practical tips on preventing crime and limiting your association's liability. So please tune in for that. Next, we do have some information on the Scottsdale Neighborhood College, which is going to be an in-person event, which will take place on Thursday, September 18th, 2025. It's going to be from 1 p.m. to 3 p.m., and this will be located at the Mustang Library. The address is 10101 North 90th Street in Scottsdale, Arizona. So please feel free to join us for that. That will be regarding the 2025 legislative update and how to effectively work with your community manager. So in that session, Beth Mulcahy will provide an easy-to-understand overview of the latest laws impacting Arizona HOAs and condos. Then she'll go ahead and dive into the unique relationship between associations and management companies, tackling common hurdles and providing practical solutions. The secret ingredient to success: teamwork. Join us to gain insights to stay ahead of the new laws and learn strategies for building a strong, effective partnership with your community manager. And also feel free to contact the City of Scottsdale with any questions on that. So with that does conclude our presentation for today. Thank you all again for joining us. We do hope that you have a great end to your summer, and we hope to see you at one of our upcoming events coming soon. So have a great rest of your day. Thanks, everyone.